After the Bank of Canada and European Central Bank last week, central banks will again take centre stage in the coming days as the US Federal Reserve and Bank of England provide their latest monetary policy decisions on Wednesday the 16th and Thursday the 17th of September respectively. Over at the Mariner S. Eccles building in Washington DC, the Fed's headline interest rate stands at a record low of 0.25%, while Chair Jay Powell and colleagues are currently holding off from further additions to their quantitative easing bond buying scheme. The Fed's total assets stand at just over $7 trillion, down $167 billion from the summer all-time high, but way up from the $4 trillion at which they entered the year. In Threadneedle Street, London, Governor Andrew Bailey and the Monetary Policy Committee currently have interest rates at 0.1%, a record low as well, and quantitative easing at £745 billion, after this year's £300 billion of increases back in March and June to help fight the economic fallout from the pandemic. Neither central bank's expected to act this time around, but both are still in a state of high alert, just in case the recovery from the first half's recession proves weaker than expected. Mr. Bailey continues to debate the merits of negative interest rates, while Mr. Powell is now saying the Fed is going to ease its inflation target, or at least adjust it, and look for 2% on average over time, meaning that it will be happy to see an overshoot after periods when it's missed that target and undershot it, as it has pretty consistently since late 2018. That really implies the Fed is prepared to run negative real interest rates for some time, whereby its headline interest rate, again currently 0.25%, runs below inflation, 1% at the last count. For you, that means your money loses purchasing power in real terms if the Fed succeeds. And this may be one reason why some investors are piling into stock markets or gold to try and protect their wealth, although it's by no means the only one, and please, that does not represent anything that could be misconstrued as financial advice. Company-wise, we have a deluge of news releases scheduled from mid and small cap firms, although FTSE 100 companies are expected to be relatively quiet by comparison. Names which may be of interest for what they say about themselves, their industry or the wider economy include the following, although some of the dates do remain subject to change. MJ Gleeson, Abcam and Keystone Law on Monday the 14th of September. Ocado on the 15th. Galliford Try in Central Asia Metals on the 16th, when Auto Trader will also host its annual general meeting for shareholders. Kia, Hilton Food and Clean on the 17th, before imminent FTSE 100 entrant BM European Value Retail will close out the week with its AGM on Friday the 18th, when City Pub Group is also currently scheduled to report. But the company which could really cause a fuss in the week ahead is Next. The multi-channel retailer is due to publish interim results on Thursday the 17th of September. Next shares are down by barely 5% in the past year, which is very creditable for a retailer, especially as the FTSE 100 is down by around a fifth over the same time span. That's despite a dividend cut from Next, of which more in a moment. The strong relative showing owes much to Next's financial strength, the power of its online offering, as well as how operating results have exceeded expectations that were initially slashed in the wake of the pandemic and lockdown. Back in July, an update showed that trading had been less bad than feared, so analysts will look how the outlook measures up compared to the scenarios outlined back then by Chief Executive Lord Simon Wolfson. After a first half sales drop of 33% year on year for full price product, Next provided three possible scenarios for the second half of sales down 5, 19 and 33%, which would leave the full year down by 18, 26 or 33% if one of them happens. Under the midpoint scenario, Next now expects pre-tax profits of £195 million for the full year, with a best outcome of 330 and a worst case of 15. That compares to £729 million a year ago, and Lord Wolfson's previous guidance midpoint of exactly 0. And under that same midpoint scenario, Next suggested that net debt would fall by £460 million, despite lower sales and profits, thanks to the scrapping of a share buyback programme, cancellation of dividend payments, asset sales and cuts in capital investment. If that forecast proves correct, then group net debt will drop to around £650 million, well within its banking facility limits. The final point of interest will be the dividend. Again, Next announced back in April that it would not pay an interim or first half dividend and will be unlikely to announce a final payment next January either. However, 8 FTSE 100 firms that cancelled dividends have since recommenced them, and with trading coming in better than expected, at least so far, some analysts may be tempted to ask whether Next might do the same at some stage and rejoin the dividend list. Last year, Next paid an interim dividend of 57.5 pence a share, but then cancelled its final payment of 110p. Intriguingly, the current analyst consensus forecast is for a full year payment for this fiscal year of just over 41 pence a share. I hope that you and your families are all in good health and good spirits during these difficult times. Thank you for listening, and I look forward to talking to you again next week.